Good morning, everybody. Thanks so much for joining us. You're live if you're here with us live, and if you're watching this back on replay, you're very welcome to sit in on a conversation with us this morning as we talk to Tom and Babs about how to get your business sale ready. I've got some intros because I want to make sure that we do everybody justice, because we have just exceptional brains with us this morning, and it would be unfair to skip over who they are and what they bring to this conversation. They are quite long, so I'm going to read them. So forgive me for looking down, but then we'll dive straight into the questions.
You must be the exceptional brain here, Tom. I'm not sure.
I was about to say, that's the best compliment I've ever had.
You can pop that on your website if you like, Tom.
It's already on there.
So Tom is the founder and director of Cadre Advisory. After training in national practice and working in-house on transactions, Tom returned to practice to focus on corporate finance, where he now helps businesses navigate their financial strategies with confidence. Spotting a shift in the profession towards tech-driven advice, Tom founded Cadre to provide businesses with actionable insights and clear practical guidance. Today, he also acts as an external CFO, supporting startups, scale-ups and growing companies to achieve their ambitions. And Babs began her legal career as a corporate and financial service regulatory solicitor at Macleay Murray and Spence, which is now Denton's. After 3 years, she transitioned to a legal and compliance role at investment management firm Martin Currie, where she worked on legal and regulatory intricacies of operating as a regulated entity. After several years in-house, Babs returned to private practice to found Jamieson Law. And over the past 5 years, Jamieson Law has helped thousands of ambitious business owners reduce risk and unlock opportunities with practical, straightforward legal support. In a nutshell, Tom and Babs worked together very recently on a business sale, and throughout that process there was lots of common ground, lots of similarities, lots of alignment in terms of how to do this well. So we thought that it would make a great conversation to bring to you. And I think it's worthwhile saying that whether or not you're preparing your business for sale up front, or whether you're considering investment, or whether or not you're considering best practice, this is all really helpful, useful information to take away. So we will make this as practical and tangible as possible. And I'm going to dive straight in for a question for you, Babs. So business sales can range in value from a few £1,000s up to multi-million pound deals, but the process is broadly the same. So can you talk from a legal perspective, what are the stages you expect to see in a business sale?
Yeah, now the process is broadly the same. If someone is buying a business that's much lower value, they might take a particular view on the risk. But in terms of the actual process and how it follows, yes, it's exactly the same, regardless of whether you're selling your business for 20 grand or 200 million, it's the same. In terms of the legal process, before lawyers would even get involved, obviously parties would tend to have their initial discussions, whether that is directly or through a broker or however it comes about. That would tend to then form the basis of a heads of terms conversation. Now, heads of terms isn't a legally binding document. That tends to confuse people a little bit. And so the question is, well, why do we have it in the first place if it's not even legally binding? It's a very good exercise to get out the key commercials. If you're selling your business and you and your buyer can't agree on the key commercials at the heads of terms stage, it's a good idea to figure that out now, rather than realise that when you've spent quite a lot of money on legal and finance help. So it's a good discipline. What I tend to find actually is that where there is more negotiation and back and forth on the heads of terms, parties can get a little bit frustrated, but the rest of the legal process tends to run a bit more smoothly. So we have that heads of terms document. As I say, it's not legally binding, but it forms the framework for the deal that we're then going to enter into. We then enter the legal documents and due diligence stage. So the buyer in most situations will draft the majority of the legal documents. That'll be the share purchase agreement or the asset purchase agreement, and most of the ancillary documents, things like board minutes, share certificates, stock transfer forms, etc. The seller would draft the disclosure letter. So that's basically where they have an opportunity to disclose anything in relation to certain promises they're making about the business, which allows them to limit their liability. That legal document process normally runs in tandem to the due diligence process. So due diligence would be ongoing on the business that's being sold. So that'll be on the legal side, and it will also be on the finance side, which is where Tom comes in. There will be lots of back and forth questions that go on and on. There might be 2 or 3 rounds, there might be more. It just depends how organised the due diligence is from the start and how many skeletons are in the closet. Those processes will run in tandem most of the time until the legal documents are agreed. Once the documents are agreed, they're signed, completed, and then for the buyer, there's Companies House filings, payment of stamp duty, and then we're done.
And then we're done.
And
really
then we're
done. And from your perspective, Tom, like where do you tend to get involved in that process, and what are the stages for you?
Well, I actually get involved. Barbara just said heads of terms. We get involved early doors with clients who want to buy or sell. We prepare the accounts and we prepare management accounts, we prepare forecasts, and we start to collect the main items that would form the part of the data room. We don't create a data room. You can use a Google Drive, start to put loan agreements, lease agreements, employee contracts, just start to pull all that together. But as I've negotiated heads of terms, they are not legally binding, but it's about, as Barbara said, ironing out the major commercials, how much you're getting and when you're getting it is probably the 2 main things people care about. But from an accountancy side, it's just about getting it done. You've got to get it done. So the best deals I've seen are when people have got access to the data rooms, because you get a thing I refer to as momentum. If momentum drifts from a deal, people get, we actually call it deal fatigue. You should be able to get it done within 6 months. But I've seen deals last 12 to 18 months because documents aren't ready, management accounts aren't ready, accounts aren't provided quickly enough. 2 to 3 months after year end, you should be looking to get your accounts done, and you should be running management accounts every month.
Yeah.
Because the buyer is going to want to see them.
So that's interesting. You've touched on a couple of points there that I want to spend a bit more time looking at. So you've talked about kind of data room, we've talked about the regularity and just like that I guess habit of getting into running your accounts on a regular basis. And that all starts to sit into a due diligence process. And I think due diligence can feel a little bit misunderstood in terms of what's involved in a due diligence process, and also utterly terrifying for people who are about to go into due diligence. So from your perspective, what are you looking for in a really robust due diligence process from a financial perspective?
We would look at everything that's financial. So it could be HR for employment contracts, finance, debt, loan agreements, putting them all in one place. Another thing people forget is a forecast. Because a buyer is going to have to do a forecast to see if they can afford to acquire. So if you have one there, it just gives people that confidence. If you're selling your house, you hoover, don't you? You know, you clean the kitchen, you present it really nicely. It's the same principle. In fact, more, that principle needs to be applied to selling your business. You've got to make it look nice. You've got to have everything, because they will find it. There's nowhere to hide, because a buyer will have a legal advisor and a financial advisor digging. It's just better to have it all there. They get confident, momentum, and you can have a good transaction. The pain comes when you've agreed heads of terms, and 6 months, 9 months later, you still haven't agreed it, because once you've agreed heads of terms, you think it's done. It's not done. It's just an agreement in principle.
Yeah.
And that concept people do struggle with. It's just an agreement in principle. Then you've got to do the pain. So if you think about buying I've actually used the analogy of buying a house. You agree a sales price, you agree a purchase price, and then it takes 6 months because you've got to get the mortgage in place. You've got to get your bank statements. You just get it all ready. You're not going to get it all, but if you get 80% of it ready,
yeah,
it's not as painful as trying to find it all.
Yeah. It's like going through the survey. I really like the house sale analogy. It's like getting.
I don't know where that came from, but
No,
I'm just selling one, so maybe that's why.
I
How
use it a lot
interesting.
because sometimes if I'm representing sellers and a buyer asks for something in the due diligence process, they'll say, well, I don't want to give that because that's private. And it's like, well, you wouldn't expect somebody to buy your house if they weren't allowed to do a survey on everything that's going on in the business. You can't ask someone for money to buy your business if you're not willing to show them everything. They have to know what they're buying. That's kind of only fair.
But that's an interesting point, actually, Babs, which is it can feel quite exposing, can't it? It's going through a due diligence process. You're sharing everything. Is there anything that a seller can do that gives them some comfort and helps to legally protect them in that process of kind of, here's my business, kind of like bones and all?
The seller needs an NDA signed, a non-disclosure agreement. Now, there's always the argument, how much is a non-disclosure agreement actually worth? Well, it's kind of worth what any legal contract's worth. You have to go to court to enforce it, but it is a deterrent from anything being leaked, and it does give you legal recourse if something is leaked. So I sometimes deal with buyers or with sellers, who come to me and they say, I've been really open with the buyer and I've just given them everything, and I've said, well, right, okay, but we're not in formal due diligence yet, so have you signed an NDA? No. Right, we need to get an NDA signed. So you have that legal protection, you have that legal recourse if something goes wrong. It does feel very exposing. It does feel like a lot when somebody's coming in and rooting around maybe a business you've ran for 20, 30 years. It can feel like a very sensitive subject. But at the end of the day, as long as you have that legal protection and as long as you're organised, like as Tom has mentioned, like they're going to discover it anyway. They're not going to get to the end of the process and have done all their legal and financial due diligence and not have found something that you wanted to hide. So actually, if you have an organised data room, if everything is laid out in a systematic fashion and you've identified issues to the buyer, that's really all you can do. If they're going to find it, they're going to find it. So you may as well just be completely upfront with them and have that NDA protection in place.
Okay. We've talked a lot, and both of you actually have mentioned several times now, data room. Tom, just coming back to you, let's go right back to basics. What is a data room, and what's the best way of structuring a data room so that both parties can find the information that they need in order to make informed decisions?
It's simply a folder that's shared with all parties. It could be, I think, the classic example is a Google Drive. We wouldn't recommend it, but if we use that principle, use a Google Drive, you can set one up yourself and you start putting the management, and then just put finance, HR, contract, suppliers, customers, sales, and you just start building it. There's no right or main reason, but we all know what needs to be in there. It's financial, it's employment, it's major contracts, and update it every month and become part of that process. Because regardless of if you're selling, buying, it's a good habit to be in. Firstly, having your management accounts in one place, having your employment contracts in one place, having your financial debt and loan agreements, HP, all in one place, because it's really easy then to find it when you've got to renew, or when if you do want to raise a loan, you can find all the documents you need. Put your bank statements in it. It's good practice. I'm not 100% sure Google Drive is the best place to put it, but I'm using it as an example. There are many options that I think solicitors use as data rooms. Some are good, some aren't so good, and but realistically, it is just a folder.
Yeah, and
you can keep that folder sat on your own server. That could be Windows 365 or Google Drive, and only when you've agreed or when your lawyer tells you you can share it, when an NDA is signed or when you are past heads of terms and you are in due diligence, then you should share it. But I think you should keep it anyway, because if you want to grow, if you want to sell, if you want to buy, you're going to need something as a Bible or gospel to go to have all your major documents in one place. It's good practice. You'd have 20, 30 years ago, you'd have a filing cabinet behind us with A to Z.
Yeah.
You know, it's same thing.
It's the equivalent, yeah. And Babs, from your perspective, that we handle a lot of merger and acquisition activity through Jamieson Law. So you've had access to a lot of data rooms and kind of the good, the bad and the ugly.
Yeah.
Like, from your perspective, what does a well-managed data room look like? From a legal perspective, what would a seller be looking for? Sorry, what would a buyer be looking for as they're going through a data room?
Just organisation. The worst data rooms don't have the right functionality. So if you're going to use a system like G Drive or whatever, you want to make sure there's a search function. That's actually really important. It sounds like a small thing, but when you end up with tons and tons of documents, it actually becomes quite major. That aside, the data room itself, it should be organised as Tom has mentioned. So you should have contracts folder, an employment folder, GDPR folder, accounts and finance folder, property. Like, you should have all of that set out. One of the worst data rooms that I saw was it wasn't subject matter defined, it was date defined. So it was like, here are all our things from July 23. And here are all our things from September 24. And so it was all over the place and it was a bit of a mess. And it actually probably added a couple of months onto the sale process that really didn't need to happen. If you're doing like Tom says and you have your data room ready from the beginning, like even before you're ready to sell, you should already be in a good discipline of it, but it should be organized by kind of subject matter and and there should be an index. It should all be very, very clear, easy to follow. Don't try do things in date order, try and do them subject specific. I'm saying that from my own painful experience. Try and have subject specific, very clear. Remember, again, the buying a house analogy, if somebody wants to come in and see if there's a problem with the bathrooms, they're going to look at the bathrooms. So if somebody wants to see if there's a problem with an employment issue, they're going to want to look at the employment documents. They're not going to want to traipse through folder after folder to try and see if there might be an employment document in there somewhere. The other thing is just naming convention. Have a really easy, straightforward naming convention. So what the document is, parties, date, and that should be enough.
I laugh a little bit when you're going to do it by date, but actually, if you don't know,
you don't know. No, you wouldn't know.
It's easy to go, well, I'll do, I'll group things, but I'll do it by some other mechanism. And at the time, you probably think you'll remember it. But if you're then 18 months down the line, there's no chance you remember what you were doing in May 23. It's impossible to go back and say, oh, I know exactly what's in that folder. So
and if it's impossible for you, it's impossible for the buyer.
Yeah, exactly that. Tom, you've mentioned a few things already in this conversation around kind of the best practice and the financial records or practices that you should have in place leading up to a sale. So things like having regular management accounts, doing your filings. You've also touched on a couple of other things that I think are interesting, which are things like if you have any loan agreements or if you've got any kind of debt finance anywhere, how would you expect to share that information and how would you make sure that's been accounted for in something like a forecast? So if there was a termination date or a repayment date, how would you make sure that's fairly reflected?
By simply having it available. The number of times I have ended up doing due diligence and trying to dig out the HP agreement because someone's asked a question. And it might be HP agreement on a printer that's been running for 4 years and it's very minimal amount. But because I would say 80% of deals or buyers will be using debt finance, serviceability from the buyer's perspective is important. So they need to disclose to a potential funder what debt is already in the business. So having that available, and you could have a schedule. Obviously I'm an accountant, so I'm a big fan of schedules. You have a loan agreement and a termination date on it. So if you had your, if we go back to the analogy of the Google Drive finance agreements, have a lead schedule with a list of the four. I mean, you might not have any, so you don't need to do it. But if you have, a lot of people have a bounce back loan still. I mean, they're still running roughly probably about 12 months left. Maybe they've had Sybil's agreement. Maybe they've got an invoice finance agreement. You may have HP on leases on cars, etc., etc. Just list them. Yeah. Start date, end date, amount a month. No one does that, and I have to do it, which is fine. But if someone had done it, again, it's just tick, and we move on. That's what the buyer wants to see. Tick. I've done it. I've checked it. And they move on. And then you get a successful, clean transaction. That's I hesitate to say it's just ticking boxes, but there is an element of that. They want to see all the financial agreements. If they've got a schedule there, they will just tick. Great, fantastic, move on.
So from both of you, there's this really overwhelming sense of actually none of this is super complicated. None of it is really difficult to navigate, but the emphasis is really on like clarity, consistency, and organization. And I would be really interested. So for business owners that are scaling quickly, very often things like keeping all of your legal contracts in one place or keeping your management accounts up to date. They might do their end of year filings, and that might be all they get to. Like, how do you suggest quickly scaling businesses that are looking to exit maybe in the next 3 to 5 years? How do you suggest that they either bring that skill set into their organization or engage with external providers to help them prepare well? Bab, so come to you first from a legal perspective.
I mean, the fact of the matter is they might be in this position because they just don't have the resource, which is very often a problem for a scaling business. If they don't have the resource, then engage with accountants, engage with lawyers, and you're not engaging to sell, but you're engaging to get sell ready, essentially. A team of lawyers can come in and help you organise your documents, but there is going to be a bit of back and forth with the client themselves, because at the end of the day, we can make things pretty in the way that a buyer would like to see them, but we need to be sent the stuff. So there will be a little bit of work still on the part of the business owner, but lawyers can generally say this is what a data room should look like and this is how it should be organised. Same with accountants. Accountants and finance advisors, they will be able to say, like, this is what a buyer would be expected to see. You know, I'm speaking for Tom's side of it here, but essentially they'll be used to doing management accounts, they'll be used to doing cash flow forecasts, balance sheets, P&Ls, all of these things. I mean, with our accountant, we work month on month doing a set of management accounts, analysing what went on in the previous month. That's just a very good practice to be getting into. So if your accountant isn't doing that, I would say engage with accountants that do. But yeah, I mean, that's kind of really it. If your business is running a lot of legal contracts, if you have a lot of supplier agreements or a lot of client agreements, it's probably a good idea to get contract management software as well. That would kind of trigger renewal dates, notice periods, that kind of thing. And again, that would become very handy for a buyer. I think the thing is, when you're coming to sell your business, if you haven't got this stuff in place, the impact is going to be on timing. It's going to add a lot of time to the transaction, but it's also going to add a lot of cost, because you're going to have to pay the advisors to do all this for you. So you either pay them early and get that dealt with, or sort it out yourself if you can find some resource in the business. It might even just be an admin role to get some of this sorted in the background.
Yeah, that's really helpful. Tom, anything to add to that?
Only that, and that's something Barbara touched on, the tech stack. We implement a tech stack, and it could be anything from going online with your books to a Xero or QuickBooks or Sage. If you're manually entering data now, you can probably save days, which would allow you then to do the work we're suggesting you can do. We implement tech stacks for a number of clients that allow them time then to run businesses. The fear factor is, oh, I've always done it this way. Yeah, that's fine. But if you are now manually entering, for example, a bank statement, you don't have to anymore. And that can take, if you're a couple of £1 million turnover company, that can take days, a month. That can just be eliminated by having an automatic feed.
Yeah.
Which then gives you your source that you're struggling to find, and also saves costs.
Yeah.
Because if your finance function is now all of a sudden has a more resource, they can then start doing management accounts. They can then start producing a data room because they're not manually posting data. And I think it can be quite scary, because if you've been doing it for 20 years on Sage Line 50, which I still think is probably one of the best bookkeeping softwares ever made, it's just not suitable anymore, because you don't need to spend that much time manually doing manual data.
Yeah, yeah, that's good.
So
That's good
embrace the tech stack. And I was critical. I can't believe this is true. Probably 10, 15 years ago, I looked at Xero and went, oh no, I called it black magic, and that'll never work. And now my whole business runs on Xero.
Yeah.
So I was guilty of it too.
Yeah, that's how I felt on QuickBooks, and I quickly moved to Xero because QuickBooks just blew my mind. Just too difficult for my little brain to comprehend.
QuickBooks, in my opinion, is built for accountants. Xero is built for business owners.
Business owners, yeah.
Yeah, I'm certainly not an accountant, so that will be why.
So just conscious of the time, I just want to quickly come to a couple of last questions. Tom, we saw at Jamieson's a huge surge of M&A activity before the 30th of October when the budget was being announced and everybody trying to get things over the line. We're now expecting another one towards the end of March as then the new tax regulations come into place. What would you be suggesting business owners are looking to sell next year, particularly if they're looking to sell in the first quarter of next year? What would you be suggesting they do now?
Firstly, don't panic. The tax will happen and the market will adjust. And also, and this is something I've said to a lot of people, if you are trying to push for a sale, the buyer knows you want to sell by the 31st of March. And that is leverage for them to reduce the price. So get your data room into a position where you can sell. Firstly, prepare to sell before you start that process. Don't panic about the tax. The tax is inevitable, unfortunately. Do not use tax as a means to rush a deal through. 10% is a large amount of money, but if you do it properly and you create the right data room, you can probably maximize your value, because people get excited, people get momentum. I go back to when I started, momentum. People reduce prices and reduce value when they get frustrated and they get fatigued by the deal.
Yeah.
You know, because they found something you haven't disclosed and they go, oh, it's not what I wanted. It's not the 3-bedroom house, it's a 2-bedroom house with a small little room. You know, it's those things can be more materially affect the value more so than a 10% tax change.
Yeah. And
also with good tax planning, if it's a family-owned business with good tax planning, you can utilize more than one entrepreneur's relief. If there's, for example, if it's a husband and wife, you both get entrepreneur's relief. So speak to your accountants and speak to your tax advisor, because tax shouldn't be your trigger point. Just forcing a deal through. The buyers know, and the buyers are waiting, and that you don't want to be in that position. Certainly don't want to be making decisions based on it anyway. Is my advice. Get it right, and you can achieve a good value.
I think that's really sage advice, Tom, and a good way to wrap up the webinar this morning. Thank you both for joining me. I love having conversations like this because I think it helps bring what feels like complicated issues to life and makes them feel much more manageable. And if you joined us live today, thank you for being here. And if you're watching on a replay, you have any comments or questions, we will add in all of the contact details below this video. So please just reach out. Thank you, everybody. Enjoy the rest of your day.
Thanks very much.
Thank you.
Bye.
Bye.